So, over the past month, amid all the fast news, the USA announced it wants to create its own sovereign wealth fund, a huge investment account to save and invest public money around the world. Similar funds are among the biggest and most powerful financial groups in the world. For example, Norway, France, China, and the oil-rich Gulf states have national investment accounts with hundreds of billions or even trillions of dollars invested in companies, real estate, and even sports teams worldwide. These sovereign wealth funds play an important role by providing a steady and reliable revenue source to run a country. At first glance, the idea of the USA building its own fund seems reasonable. However, many economists, financiers, and commentators say it might be a bit silly, though that may not be entirely fair. Usually these funds come from countries with large natural resource incomes that save money for the future. And now, the USA is the biggest oil producer ever. If there was a good time to start saving, it is now. Also, a sovereign wealth fund does not need to be as large as Norway's to work well. Even a smaller investment, when adjusted for the size of the US economy, could still be significant in global markets. This idea has many pros and cons that must be looked at closely. So, how would a US sovereign wealth fund work? What issues must it overcome? And what new problems might it cause? In the past, many countries have set aside wealth for emergencies, wars, or poor harvests. In a way, grain silos and gold reserves were the first sovereign wealth funds. Over the last 50 years or so, the idea has been refined by using global trade, finance, and increased wealth to create today's modern funds. This change happened because, until recently, no country had seen such strong growth. It wasn't until countries like Qatar, with their emerging oil industries, that nations began experimenting with their extra cash and strong foreign exchange reserves. Before we continue, if you're enjoying this video so far, please hit that subscribe button and give it a like. It really helps in supporting the channel, plus, it's free. Let's get back into the video. Today, there are almost 100 sovereign wealth funds that together equal about 10% of the world's GDP. But they do not all follow the original idea. Each country designs its fund differently based on its own goals. Some are very good, some are poor, and some are confusing. Norway is seen as the model when it comes to sovereign wealth funds. They take money from oil and gas revenues and turn it into financial wealth by investing in assets around the world. This way, Norway saves money for the future when oil runs out, and its revenue is not tied to daily oil prices. Their fund works like a shock absorber for the oil industry and helps prevent Dutch disease. They also help local industries avoid being overwhelmed by oil money. In contrast, some countries like those in the Gulf states start with a similar idea, but their funds lack transparency and are often used as a large piggy bank instead of being focused solely on public finances. Although oil and natural resource money started this trend, many sovereign wealth funds today do not rely on natural resource revenue. For example, Australia has its Future Fund, which was created from the sale of public companies in the early 2000s. They might have built their own resource-based system, but that is another topic. What is making news now is the US plan to create a federal sovereign wealth fund. Some states, like Alaska, already have their own funds, but it seems odd to pursue this at the federal level because, despite its economic power, the US government does not have the extra wealth needed to create such a fund. Right now, the USA produces a lot of oil, about 827.1 million metric tons in 2023, and production is expected to grow under the current administration. However, the US does not tax oil production as effectively as countries like Norway. In fact, the US government spends a lot on subsidies for the oil industry. For example, the intangible drilling cost deduction lets companies write off most of the cost of drilling new wells. While this may boost the industry, it is estimated to cost the government $13 billion in tax revenue over the next 10 years. There are also indirect subsidies like the foreign tax credit. When American companies pay royalties overseas, they can deduct these costs, or even treat them as if they are foreign taxes, which gives them an even bigger tax break. Without this, the government might earn an extra $12.7 billion in that time. This situation comes from differences in how oil and natural resources are managed. In many countries such as Norway, Saudi Arabia, and Canada, natural resources belong to the government. In the USA, however, they belong to the landowner, which means the government has to encourage drilling in ways that may not be as profitable for public funds. Although there are fees and rents charged to companies drilling on public lands and offshore, these are very small and mixed in with other revenues. This does not mean a fund is impossible. It just means the government would have to find wealth from other sources. If the US wanted to start a fund, it could set aside money from its budget every year. But the main problem is that the country already spends more than it earns. Typically, sovereign wealth funds are built when a country has a budget surplus. With programs like DOGE cutting spending immediately, it does not make sense to create a fund using money from the budget. Estimates differ, but extending the 2017 tax provisions might cost the US $4.2 trillion over the next decade. In total, the government might lose between $5 and $11 trillion in revenue over the next 10 years if the full tax plan extensions and new cuts is implemented. All this means that if the government is taking drastic steps to cut spending and expects less income, it may not be the right time to start investing. It is like someone who is about to have their pay reduced, already eating cheap meals, and then deciding to open an investment account. Still, technically, the US could make it work, but it would not look like the typical sovereign wealth funds we know from before. This difference is partly because of one thing that helped the US survive for over 200 years. Good credit. The US can borrow money at very low cost compared to almost anyone else. Even though debt is growing quickly, the country has never defaulted on its modern sovereign debt, despite its somewhat poor reputation. Currently, US Treasury rates are around 4.3% to 4.7%, while long-term market returns are usually between 7% and 12%. This means the government can borrow money and earn a profit on the difference. Although this sounds reasonable, the risk is that if the stock market crashes, the debt still must be repaid like any other leveraged position. In the worst-case scenario, this could hurt the stability of the US currency and its debt. Then, the fund would be less like a sovereign wealth fund and more like a sovereign leveraged investment fund, which might not be a deal-breaker, but it is risky. There is also the issue of scale. The United States is a huge country with an economy so large that many other nations care about its survival. To put it in perspective, Norway now has over $2 trillion invested, making it the largest sovereign wealth fund in the world. But it only has about 6 million people, much fewer than the average US state. To make a noticeable impact on fiscal issues, the US would need a lot more capital. With all these issues that the US might face in the future, one must ask, why would the US want to start a sovereign wealth fund in the first place? Countries like the UK are thinking about it too, even though neither has enough extra money to create a fund in the traditional, safe way. 3 main reasons seem to support the idea. First, there is geopolitical posturing. Our rivals have such funds, so why not we? The China Investment Corporation, CIC, is the second largest fund in the world with about $1.3 trillion in assets. It is built very differently from Norway's fund because it is mostly funded by China's foreign exchange reserves from trade surpluses, and it is very disorganized due to bureaucratic issues. However, it has become a source of national pride, which the current US administration might want to change. Secondly, there is a kind of bragging involved. Using assets to show how well the economy is doing. No country is above this kind of display. Norway uses its annual reports to show its top holdings like Apple, Microsoft, and New York real estate. China uses it as a soft power move, and Qatar shows off its ownership of landmarks like the London Shard and Harrods. But this reason is a bit silly. The US seems very keen on using a sovereign wealth fund to boost its image through assets, even though the US and the UK have more liabilities than assets, and much of their asset collection is not liquid. Thirdly, on the domestic side, the current US administration may only be in power for another 4 years, but both political parties want to extend their influence. A sovereign wealth fund could help their image on the campaign trail. Additionally, such a fund could protect investments from changes in government if the next campaign fails. Countries like France have set up non-traditional funds to invest in green energy, infrastructure, and entrepreneurship long-term projects managed by a public institution that remains stable after government changes. This idea is tricky because, at the moment, the U.S. executive branch wants full control over investments. There is nothing to stop a new leadership from completely changing everything when they take over. Thanks for watching. If you enjoyed this video, please subscribe and hit the like button so you don't miss out on our future updates.